Hey everybody, Adam Schmela here, Certified Financial Planner with Integrated Planning and Wealth Management, talking to you today about one of the biggest planning opportunities that came out of the Tax Cuts and Jobs Act that was passed, that piece of legislation that passed in December of 2017, one of the biggest pieces of tax reform legislation that has passed in recent memory. Specifically, what we're going to be talking about today is something called the Section 199A deduction, or the Qualified Business Income Deduction. Now, I'm going to be talking to all of you healthcare professionals, the dentists, the optometrists, the physicians, the pharmacists. If you own your own business or you're a 1099 contractor with any of those organizations or any of those businesses, you're going to want to pay attention today because there are some unique planning opportunities that can have a pretty sizable impact on the tax bill that you have to pay come April 15th or come tax filing time. So let's run through some of the basic high-level principles and concepts of the 199A deduction. If you're not already talking about this with your advisors, with your planners, with your CPA and tax preparers, it is a conversation that you're going to want to have to start, or that you're going to want to start yesterday from a planning standpoint, because a lot of what we're talking about here today is needs to be done in order to take advantage of it. You need to be proactive with it rather than reactive. So let's run through some of the high-level concepts, and if you have additional questions, let us know or talk to your advisors to make sure that you're planning for your unique financial situation and circumstances. So what is the 199A deduction? Well, it deals with something called qualified business income. Qualified business income, the first question that we have to ask is, are you a specified service business? Because whether you are or not will dictate if and how much of that deduction you're able to take on your tax return when you file your personal tax return. So you see I have SSBI over here. What is SSBI? SSBI stands for Specified Service Business Income. If you are a specified service business, those are going to be professionals and businesses in the law, healthcare, basically professional services where the majority of the revenue is generated in that business because of the intellectual property, because of the person involved in that organization. So basically, in a round way or big high level thinking, unless you're an architectural firm, an engineering firm, a construction firm, things like that, you will most likely be a specified service business. Now, if you are a specified service business and you are under the limits that we're going to be talking about here, you have the opportunity to take a 20% deduction on your tax return for your specified service business. So whatever this income is, take 20% of it, that's the deduction on your tax return. Now, how do we determine if you fall under this category, if you can use this planning opportunity? First of all, it depends on whether you are married or married filing a joint return, or whether you are single and filing your tax return that way. If you are a single individual, you notice I have TI written over here. TI stands for taxable income. Now, an important concept to understand, because a lot of what we used to think of from a planning standpoint was we would always focus on AGI, adjusted gross income. Adjusted gross income, if you looked at your tax return, that was the bottom number on page 1 of your 1040. Today, for this specific planning opportunity, we have to understand that we're talking about taxable income. Now, why is this important? Not necessarily important if you're single, because your income is your income. But if you're married filing jointly and your spouse is working outside the home, their income is figured into this equation, which will dictate whether or not you qualify for the SBI, for the specified service business, for the QBI deduction. So we're talking about taxable income. So if your income is at or below $157,500, taxable income, at or below this number, single, married filing jointly, if it's at or below $315,000, congratulations, you are able, for the qualified business income, how you calculate that is beyond the scope of this video here, but for the amount of QBI that you have, congratulations, you can take the full 20% deduction on that income. If your income is at or above $207,500 or single, or $415,000 in a married filing joint tax return, again, taxable income, I'm sorry, do not pass go, do not collect $200. You are not able to take advantage of any of the QBI deductions. So the planning opportunity here is, how do we get, before I get further, if your income is in between here, there's a sliding scale that dictates how much of this deduction you would be able to take. So just know that if you're in this range, number one, you can take advantage of it. Number two, you want to do everything you can to understand how to leverage some of these planning opportunities to get your income, if possible, at or below this or this number. So here's some planning opportunities to take back to your team to think about as it pertains to your personal situation, to figure out, can you take advantage of this planning opportunity? So some planning strategies. Number one, donor advised funds. If you are charitably inclined and you want to make sure that you honor those commitments to the organizations that you want to support, look into whether or not using donor advised funds is a way to accelerate your gifting or use your gifting to not only help you reduce your taxable income to take advantage of this, but set up correctly, donor advised funds can actually provide ongoing gifting to the organization that you support. So number one, donor advised funds. Number two, work less. When you do the math, especially if you're in this window or in this window here, when you think about the marginal tax rate and the amount of money that you're making in this window and how much of it is being taxed by the government versus how much you actually get to take home, and you figure out that return on time, right? How much work did I have to do in order to generate this revenue? You may find answering the quality of life question and figuring out, do I really want to spend my time doing that? It may, especially, and this is applicable if you're later in your career, you may find that the return on your time, and while it's hard to figure this into the overall concept and calculation, work-life balance, having a good quality of life, so working less might actually be a good planning opportunity. Third, look at retirement plan contributions. If you have a 401k with a safe harbor provision, which allows you to maximize as a business owner and kind of pass those testing requirements in qualified plans, this may be an opportunity to look at what are called cash balance plans, kind of a pension-like planning scenario. So look into possibly ramping up your retirement plan contributions to reduce your taxable income at the household level. Entity selection, so based off of how your business is set up, changing that entity structure, again, have these conversations with your planning team, but changing that entity structure may give you additional planning opportunities. Real estate spin-offs, this one's applicable if you are a business owner and you also own the real estate with which your business is operating on. So our dentists that own buildings, optometrists that own buildings, pharmacists that own your own buildings, medical professionals, or anybody in this specified service business, if you own the real estate, have the conversation of whether or not it makes sense, if you haven't already, to spin off that business into another entity and then lease. Basically, you're leasing your business that's operating on that real estate is being leased by the company that owns the real estate. You have to pay fair market rent, and there's a lot of check boxes that you have to check there. But it can give you an opportunity to now have that real estate holding company not be a specified service business income, and potentially you could qualify for the deduction through that. So real estate spinoffs, for those of you that are associates in practices or in organizations where you are a 1099 or if you're a W-2 employee, in all honesty, have the conversation of whether it makes sense to reclassify yourself not as a W-2 employee, but as a 1099 contractor. That used to be not what we wanted, because we wanted to have our employer pay half of our Medicare and Social Security tax, pay their fair wage, or not pay their fair wage, but treat you like an employee because you were. But this unique planning opportunity, if you are an associate or if you're another provider in a medical practice, run the numbers, talk to your employer, talk to your advisors about whether changing your classification status from a W-2 to a 1099 contractor may give you that opportunity to take advantage of some of these planning opportunities. So again, I know this is a lot of information. There's a lot here. I hope you enjoyed it. I hope it gives you some additional planning conversations to have with your team. Again, a lot of what I talked about here needs to be proactively done. So have those conversations right now as you're planning for fourth quarter taxes and ramping up for 2019 and how you set things up for 2019 and beyond. So thanks so much. Enjoy the day.